So the way the income and the serviceability calculation works,
Mhm,
it's determining your net income position.
mhm,
So we're looking at gross income minus taxation, minus your living expenses and any properties in your personal name. And then we take into account things like negative gearing.
mhm,
And we end up with a net income figure. So let's say we do all the numbers and you've got 50,000 after tax, after all of your expenses to put into property.
mhm.
When the lender's doing their assessment to see whether you can afford a new property, they take into account the rental income and they buffer the home loan with the 3% buffer,
Mhm.
and they have a look, and most of the time it's negative, and they eat away some of that 50,000. If they're looking at the different trust structures, as long as they're washing their own face and they're positive, right, it's not going to have an impact on your 50,000 net income. Your overall position is going to be the same, if not better,
Mhm.
factoring in some income from that trust.
So the trust has got to be positive. It's got to be
Correct.
net positive.
Mhm.
And then once that trust becomes net positive, so let's say you've got a property in there and it becomes net positive, the money that the trust has borrowed is no longer seen as money that's borrowed under your personal name anymore,
Correct. Yeah.
which basically opens up your borrowing capacity again.
That's right. Yes. And the reason for that is entities, so
Mhm.
companies and trusts, fall under a different set of lending rules
Mm,
than an individual.
mm,
So it's something we call the NCCP, is
mhm,
the guidelines, the credit code around how those different entities are treated. There are certain consumer protections that are on the consumer side that don't carry across to the business side.
mhm.
And part of that is if it's positive, there's no legal obligation for the lender to go in depth into those different trusts
Yeah.
and review and make sure they're positive. Now, not all lenders will do that. Some will want to see into every single entity.
Mm,
And that's why it's important not to DIY it and to get the correct structure and advice. But essentially, that's how it comes together.
Yeah.
So it's just using different entities to protect your net income.
mhm.
The problem is if your trust is negative, then it does have a material effect on that overall calculation.
Yeah.
So if you've got a 5 grand loss in trust number one, that comes down to you personally. Well, it doesn't, but for the income calculation example,
Yeah.
let's say it gets minused off your 50,000, your net income position will change. So that trust needs to be factored in.
Yep.
The minute it's factored in, then instead of just looking at the trust as the rental income less the loan repayment or the interest, now all of a sudden it's the rental income minus the haircut the lender applies and then the repayment plus the 3% buffer.